Well, thanks everyone for coming to the last paper of the day and for your precious lunch or dinner time. This is a joint work with the JKO. It's almost 3 a.m. in Korea. I guess he will prefer a bed in room instead of a waiting room in the Zoom. Okay, so I was talking about the cross-asset information synergy in mutual fund families. Earlier today, you have heard the two papers by Simona and Huaiji Chen, both about the mutual fund. What you probably didn't aware of is that mutual fund families are the primary overlapping investor in both equity and corporate bond. So among all the assets issued by United States corporations, mutual fund family holding 33% in equity and 25% of corporation bonds by the US corporations. If we're looking at the two figures on the bottom, by the end of the 2018, okay, mutual fund has different types. Most of them only invest in equities, some only invest in bond, some is mixture. So the darkest bar, which shows that it's mutual fund holding both equity fund and bond funds. In terms of number, there are only about 150 out of 750, but this is a small number of mutual fund families. They control 96.7%, about the 17 trillion total asset in the mutual fund families. So this is the reality in the world. And as a person study a lot on the corporate bond, I naturally want to ask one question. If equity funds and bond funds in the same fund family, they hold the same firms, equity and bonds, will their investment decision on commonly held firms correlated? This is a simple question, and your immediate response is, why not, right? But then we ask a lot of these academic people and the mutual fund managers, we got some things quite different. So we wonder, does the organization structure of the mutual fund families would affect the investment decision on the cross-holding relationship? And our baseline is that the bond investor and equity investors, they have a non-redundant information. They focus on different aspects of the firm. So if this is the case, would such a cross-holding facilitate price-relevant information spillover and then do something good for the mutual fund families, and to the general investor by creating profit? That's a simple question we want to ask. So we are familiar with Merton model. Theoretically, equities and corporate bond issued by the same firm are just a different contingent claim on the same cash flow. So by design, their value should be related. So should be their holdings. However, if you're looking at the entire literature empirically, the two markets are quite segmented due to many reasons, institutional and informational frictions. Some evidence show that information embedded in equity and bond, even the same firm, they are not completely redundant. And the shareholders, creditors of the same firm, they have different marginal information that is the other side often either they don't have or they don't pay attention to. And other literature is showing that, it's extremely challenging to synthesize information across the asset equity side and the bond side, because they just two types of different investors. They have different risk appetites, and even the risk factors affecting the bond pricing and equity pricing is different, which is one of my JFE papers. So this is what the literature. I skipped a lot of the literature in the mutual fund literature. We also interviewed a lot of people in academia and the equity and bond fund managers. From the academia, we asked both Daryl and Francis. Francis mentioned, Francis has a lot of experience on the Wall Street consulting on fixed income. He said, at every firm I have worked with, there is a huge culture gap between fixed income and equity, and two often use completely different systems. And I remember before I joining New York Fed, I visited the Lehman Brothers at that time in 2008. Their equity fund team and the bond fund team, indeed in the same floor, but they don't talk at all. They don't communicate. So I was bringing this question to one of the founders of BlackRock, and his first question is, Jennie, is that legal for the equity fund and bond fund to talk to each other? And when I asked this question to the ex-CEO about the Vanguard, he said, absolutely not. Their equity team and bond team, they don't talk at all. So from a lot of what we heard in the industry, it seems like not necessarily, and or at least it's unclear. Probably that's not the case. And from the academic literature, there's a huge market segmentation between the equity and bond that can also hinder such case. So here's the paper. We want to study this simple question. We using the CRSP mutual fund survivor bias-free data set. Okay. For many details, you can see the paper. I just talk about the highlights. We focus on fund families with both domestic equity funds and bond funds. As mentioned, they control 97% of the total mutual fund market asset. And those funds has to be actively managed, ignore those index link, the balance, the ETF, everything else. And it has to be the firms they're holding is public firms trading in stock exchange and trading over the counter in the United States market. For a little bit more than a decade, the data, we do the studies. In the morning, while you're talking about the bond fund, talking about misclassification, well, this issue is far severe for the other dimensions in the bond fund. So the equity mutual fund is well established. People can rely on style and objective codes to identify which fund is equity, or they can check what is the percentage holding using some fund summary data to identify it. When you go to the bond side, if you're using any of this tradition, either the objective codes or using the fund summary, what I found is they are extremely poor quality. So in the end, what we do is bottom-up methodology. For each of the fund, all their holdings, we try to link each CUSIP. I'm sorry, that's dark. Let me open the light. We try to link to whoever the equities and bonds they are issued, emergent and CRSP. So this way you can know this is a genuine equities and bonds. And then we aggregate ups together, requiring each fund's holding on each of the asset has to be larger than 50%. Well, we did a lot of a robustness check on here. So it's pretty much doesn't matter choosing a different threshold. So that's one key challenge is identify actively trading the equity funds, in particular bond funds. The second thing is more tedious. You need to identify cross-holding. So it's equity funds, bond funds holding the same firm's equity and bonds, but how do you link them together? Okay, and this is, we did a lot of manual linking and taking care of the merger and acquisition history. The key concept in this paper is cross-holding of sister funds. So let me show you an illustration. Let's talk about two fund families, Invesco and the Fidelity. Of course, each of the fund family has hundreds of even thousands of the funds, but basically they can classify it as equity funds and bond funds. Okay. So here, Invesco's equity funds holding the Tesla stock, and their bond funds also holding Tesla bond. In this simple case, the equity and bond funds in Invesco can be called sister funds, cross-holding Tesla's assets. Okay, it's worth noting that this cross-holding has to be identified in the fund family level and for each particular firm at a given quarter. So when I'm talking about Invesco's bond fund holding Tesla bond, I actually mentioned it's aggregated across all bond funds. You know, it could be high income fund, intermediate bond fund, short-term bond fund, whatever it is. So it's aggregated within funds. And when we talk about sister funds, we actually not specifically mention we need to choose a fund. It's actually just a convenience way. It's because everything is identified at the fund family level. So now you can see Invesco have Tesla stock and Tesla bond. Fidelity also has a Tesla bond, but do not have a Tesla stock. In this way, okay, let me clear my drawing. In this way, the Tesla stock, the equity side from Invesco, and the bond fund in Fidelity, they also cross-holding Teslas, but they belong to the counterfactual sister funds. The simple reason you're holding the same firm, but they're coming from different fund families. Okay, so this is a counterfactual sister funds. If you have any question, please let me know. This is a key concept. The understanding of it will affect your understanding of all the results following. So our simple hypothesis is whether organization structure play a role. Does the investment decision on the cross-holding firms like Invesco's Tesla equity and Invesco's Tesla bond will be different from Invesco's equity on the Fidelity's bond fund on the same Tesla stock, okay? So whether it's a cross-holding relationship will be different. Theta and theta prime, which should be anything different for this co-movement between the equity side percentage holding change and bond side percentage holding change. Here, delta H is the percentage change in quantity, which is number of shares of firm I's equity and bond held by fund family F at a given quarter T. So this is the first question we want to empirical test to test. And then if we find anything in that, we find this is significantly different, we wonder whether such difference of the cross-holding relationship of counterfactual sister funds is result from cross-asset bond and equity information synergy that is not available to the counterfactual ones. That is goal about this paper. So I want to first show you the cross-holding relationship, and then we talk about the profits from it. We start from the sister funds, the cross-holding relationship. As you can tell, there is a significant positive relationship between the percentage change on a same firm's equity and the same firm's bond if their holding of the equity fund and bond fund both belongs to the same fund family F, okay? From column 1 to column 5, we sequentially add on more and more stringent fixed effect. The most stringent is column 5, which there you have the fund family fixed effect and also firm and time two-way fixed effect. So this firm and time two-way fixed effect will tell you any news, specific news related to this firm will be absorbed by this firm fixed effect. So any of this theta reflecting is on top of the public news. It's really related to the organizational structure. If you're looking at the column 4, this coefficient translated to economic significance means one standard deviation increase in bond holding will relate to 1.4% increase in the same firm's equity holding. Well, is this large or not? Given that the average equity holding is only 12%, this is more than 1/10 about the same. So it's quite significant. Of course, I'm going to show you more benchmarks, what we should expect on this cross-holding relationship. Now, if you look at the relationship for counterfactual sister funds, same regression, only difference is it's the same firm, but this firm belongs to fund family F's equity fund and fund family F prime's bond fund. Okay, we're testing the theta. We first just random match a fund family to F and F prime, and then bootstrap the experiment for 100 times. The bottom left figure show you the histogram distribution about the estimated theta prime. And here is matched benchmark. So as you can tell, the sister funds, their cross-holding relationship is significant, about 4%. But for this counterfactual sister funds, the average about this histogram is only 1 basis point, 10 basis point. If you're looking at the t-stats on the right figure, this is showing most of them is not significant. So fund families, you can see, okay, the difference of them may be because fund families, they have skill to attracting similar skills and the qualities of the managers. To do that, controlling for that case, we conditional matching the fund family by fund family features, the size, the turnover, the expense ratio, and the fee. So make sure we are comparing apple to apple, orange to orange, two similar fund family in every dimension, their equity fund, bond fund, this relationship. But once again, the result is even clear. This is significantly almost close to 0, and only 3 are slightly significant out of the 100 test. Okay, so this is a sharp contrast for the cross-holding relationship of the factor sister funds and counterfactor sister funds. And many of this strong fixed effect, and we done tons of robustness check. We want to rule out many issues. It's not due to industry shocks, it affecting both sides. It's not due to common reaction to firm-specific news, because firm time fixed effect will absorb it. Okay, if anything happened to this firm, you should not expecting the bond and equities relationship will be different simply because they are in the same fund family, or because they are not belongs to the same fund family. It should be the similar, but we show this is not the case. We also, by this conditional matching fund family features, we can mitigate concerns any fund family in critical movement. For example, some fund family, they do advertising, so they a lot of flow story, they attract a lot of inflows, or they might have a lot of outflows simultaneously. So both equity and bond might have this thing. Okay, we conditional matching try to control for that. We also have another robustness check using flow adjusted holding change to address this issue. Again, the result is super robust. Or sometimes fund family, this fidelity has a goal. I want to avoid the counterparty to this firm. So they might reduce their investment on simultaneously on the same firm's equity and bond. So this way, we also control for that and all kinds of these issues. Now, if we want to merge them together, you can see what is marginal contribution of the equities holding change, investment decision change relative to those bond funds in the same family and bond funds from different family. You can tell clearly you can reject theta equal to theta prime, given that only theta is significant, theta prime is insignificant. And lastly, I want to show you one more thing, what we should expect for the cross-holding relationship, okay? So it's the same firms, equity and bonds. If you aggregate their holdings across all mutual fund investors, and this should providing a lower boundary. It doesn't matter who holding them, as long as mutual fund holding them, you aggregate them. As you can tell, the relationship is insignificant, even less than 1 basis point. And this is again confirming the empirical literature, bond market, equity market are segmented. They not necessary, anything happened on the firm, their bond movement and the equity movement is not necessary to move together. This is a lower boundary. What should be the upper boundary? In the mutual fund literature, there is one side literature called side-by-side management. So they show the managers holding the same mutual fund and another hedge fund. Whatever is overlapping holding, they tend to show this side-by-side, using the side-by-side information advantage, they can have a bigger movement. This will providing the upper bound limit thing. So we now focused on mixed assets and balanced fund. In those funds, they have the same firms, equity and bond, okay? And then if you're checking this relationship, yes, it's significant and it's much higher. It's about 9% or even 11%. But what happened, the key here is once you including the firm time fixed effect, the significance is completely gone. Why? It's the same manager managing bond and equity within the same fund. So it's coming from only one source of information. Any public news, you still have the same interpretation. You just implement your interpretation simultaneously on your equity and bond holdings. The key suggesting here is the cross-holding has some different information channels. It's not homogeneous information about the firm. It's different perspective from the shareholder, from the creditor. If you augment those information, that can really contributing to these things. Okay. So far, hopefully I show you the organization structure of fund family matters. The cross-holding relationship of sister funds, equity and bond, is significantly different from that of counterfactual funds. And this is not due to common reaction to firm fundamental shocks, to fund family features, to idiosyncratic random mechanical reason, to flow story, to skew story. But you cannot rule out all the non-information channels. Okay, so what we should do is to show that cross-holding relationship of sister funds, if they are truly due to information story, and they should bring some significant benefits, because any non-information channels will not create robust and long-term profits. That's the key about it. That is also the point about this paper. Yes, you are curious to see equity fund, bond fund holding the same firms, whether their relationship is different. So what? Why we should care about it? And I want to show you this is actually important because entire Wall Street ignores such case. They think the equity and bond should not communicate, but I'm showing you, providing systematic evidence showing you if you do listen to the other side, just by hearing different things from the perspective of creditors, combining the shareholder and the creditor's information, it really augments the firm's overall information and can help you make profit. So this is now what I'm showing you. This is by no means an easy task. It's very challenging. When I first do this paper, there are so many ready literature in mutual fund. You can check how they measure the performance. One typical measure is ROE or risk-adjusted returns, but this cannot be applied to our case. Think about it. If this return of a fund or fund family, that is capturing the overall performance, you don't know what exactly is, not specifically one due to cross-holding. What I didn't show you is, it's not common for fund families cross-holding firms. Almost for every 100 firms held by the equity funds, on average, only 10 firms are cross-held by the same fund families, bond funds. So they're holding a lot of things. The overall performance could be due to cross-holding, but dominatingly is due to non-cross-holding thing. So you cannot using the fund or fund families return, even if it's risk-adjusted, it doesn't help. Another type of measure is Cohen's JPE paper. So they decomposing the fund's asset into two portfolios. So they show if the fund manager is more connected to the corporation's board, for example, those firms, those stocks that they invest connected and firms not connected, they tend to have different performance. But here, our whole point is we cannot claim, or we do not claim, if firms under sister funds cross-holding, they're necessary to perform better. We're not ambitious to answer that question. So this is totally new for the mutual fund literature. And then we come up with 3 novel tests. Yeah. The first one is whether cross-holding help make more profit enhancement investment. If you can get the information timely, you might reduce your holdings before it's a negative return, or increase your holding before it's a positive return. So this is showing if the profit is significantly different because of your cross-holding or not. So if sister funds cross-holding the same firm, they have about a 10% higher chance to make more make more timely adjustment to their holdings. Another special case is initial acquisition. This is for the first time fund family holding the same firm's equity and bond. Before, they might only holding one side. So the first time initial acquisition, usually a lot of related to the information acquirement. Now you can see the initial acquisition, you have a 20 to 27% higher chance, almost 1/3 of it, to gain profit than it. The most of it is to showing the cross-holding really can help predicting future returns. Let me be short. So this is that we want to focus on the equity return based on the cross-holding, average cross-holding of the bond side. Either it's by cross-holding families or by stand-alone fund families. Okay, and we want to show you, this is a result by cross-holding, stand-alone from bond side, controlling for the cross-holding by the equity. As you can tell, the significance only comes from the cross-holding things, which means that if you're a general investor, you're only looking at the firm's overall holding by equity and by bond, you cannot benefit. You should really pay attention to the holdings by only the cross-holding thing, which allow the soft information to communicate the things. And if you convert this predictability into investment strategy by double sorting the cross-holding in equity and bond, you can earn some abnormal alpha between 2% to 0.5% quarterly, which is very large in terms of the annual things. So this is generally benefiting for all of them. I don't think I have time to talk about information thing. Overall, I want to emphasize one thing you can take away. So many literature looking at homogeneous information on the equities, but we should really looking at is equity and bond, each has unique information on the same firm. Okay, if you're combining those perspectives from shareholders and the creditor, you can really augment the information and benefiting the investors. So it's overall, it's very important for equity investor and bond investor to collaborate. At the current moment, the cross-holding percentage is only about 11%. As I mentioned, every 100 firms you own in equity, only 10 of them is cross-hold in the same fund in the same fund family. There's a huge growth space for you to collaborating. If you're holding both the equity and bond of the same firm, turned out you're more likely to gain more profit. Thank you very much.
Thank you, Jenny. That was excellent. Thank you, Nataliya. Gerasimova, she's gonna give the discussion. Nataliya is from Norwegian School of Economics. Thank you, Nataliya. The screen is yours for 15 minutes.
So, hi everyone. Thanks for staying for the last presentation for today. It was quite a long day, interesting day. I think it was the same yesterday. I would like to thank the organizers to ask me to discuss this paper. Also to thank Jennie for the great paper. I really think it's a big contribution to the asset management literature. And I hope that my discussion would actually complement a bit today's presentation, because I don't have lots of numbers on my slides, but I have some comments about information channels. So let me start. I was also surprised as Jennie that there is no study, also to the best of my knowledge, which looks at the equity holdings and bond holdings of the same fund family. So many studies focus on equity holdings and then look at different channels, how you could get this information, where you could go, and whether it's private or public one, and so on and so forth. So the goal of this paper is to check whether mutual fund families would share information about bonds and stocks with each other, and whether it would reduce segmentation, which is, as I understood, a common view in asset pricing literature, that there's lots of frictions which not allow, or that wouldn't make sense for equity fund managers to know anything about bond holdings. So they check whether it's true. And to do this, they explore sister funds. So they look at the investment decisions of equity and bond funds in the same family, and then they look at the standalone funds, for example, equity fund, and check whether this equity fund in the family was benefiting from some information. So first result, that indeed they found significant co-movement in equity and bond holdings of sister funds. So if there is a, let's say, Apple bond, and there is some change in the holdings, then probably simultaneously during this quarter, unfortunately for the mutual funds, we don't have like granular daily data, daily holdings, so it's all at the quarter level, but they show that there will be also changes in the equity holdings and in the same direction if these two funds belong to the same family. Moreover, in order to highlight the information channel, they look whether these holdings are going to predict future returns. So whether there is some additional information which equity fund managers might use in order to get abnormal returns. Actually, this part of the paper focuses on the equity returns, and most of my discussion would also focus on the equity ones for the reason that for the bond returns, there is a lack of data. And what's in this paper, that alternative channels, as Jennie already mentioned, are carefully ruled out. So I really believe that there's some information story going on, and the rest of my discussion would focus on this information channel for this reason, and also because of the name of the conference. So it's all about financial information. So my first comment, again, I think the paper is really great. It was not so easy to find some drawbacks, actually almost closer to impossible. What I would like to highlight, that I think it's also coming from Jennie's background. I've seen that she has lots of papers on bonds, so it's really a fresh look on the asset management literature. So what was done before, there was an equity fund, then there's another equity fund in the same family, and then many papers look whether there was some spillover or like sharing of information between these two players. Then on top of that, you could also see, even if it's like passive equity fund, especially with the increasing with the growth of passive investments, that there could be also some advantages. Then people looked, as Jennie mentioned, for the equity fund and the hedge fund. So if they're under one roof, that there is some additional information from the hedge fund which would come to the equity fund. Then the second also was like pension fund. Pension fund managers also might share the information with the mutual fund managers and the other way around. So what's the most important thing? It's all about equity. The same for the firms. Lots of papers look at the connections where there's some inside information. One of them would be by Cohen, like where they look at the board connection. So if mutual equity fund manager was going to the same university as a board member of a firm, there would be some information sharing. Then the last, one of the last players would be like service providers or banks. If mutual funds are affiliated to the banks, there is also evidence they're going to share with the equity funds. So what's this paper doing? Again, fresh look. They look what happens, why not to look at the equity fund and bond funds which belong to the same family. So Jennie already showed like her diagram, but mine is even easier. So let's assume that the fund family K has equity funds and bond funds, and then there's firm A, and this fund is going to invest both in stocks and in bonds. So this is like the main player, or like the main agent in this paper, and the counterfactual one would be, let's assume there's fund family J, equity fund invest into the same stocks, no additional information about bonds. So what they find, as Jennie said, and I already mentioned, there would be correlation in their change of the holdings, and then they would get future returns. Where I would like to comment more, I think actually this paper is already, as I said, well developed, and it's more maybe for the sequence of the papers further, or like I would like to know a bit more about the mechanism. So even if it's information channel, I agree, completely agree, but there could be still different frictions going on. So how it works? Also, Jennie says like we don't really need any private information sharing. I agree. So what's going on? We have public information use. Then equity fund manager has some interpretation of that. There is also bond fund manager, also some interpretation of public information. Again, we don't need any insider information. And then that's what they call synthesizing. I would like to be, maybe authors to be a bit more careful, because when I was reading the paper, these two terms, synthesizing and synergy, were interchanging. It was not so clear exactly what's going on, and they also give definition to the synergy. And they also claim in the paper that synergy, and it's in all other areas, it's larger than the sum of two. So if you look at the equity interpretation plus bond interpretation, if it's indeed synergy, then I think the signal which, when equity fund manager knows that there is some signal from the bond funds, it should come if he or she changes equity signal interpretation, then it is synergy. As long as it is just equity as a one set, and then bond interpretation as the second set, it would be just a sum. So I would like really to know whether it's synthesizing or whether it's synergy which is going on. Again, for the standalone fund, we just don't have any bond interpretation, so it's just equity signal. Another, like to continue this comment, would be a story of limited attention. So even if I start to collect this new information, probably as an equity fund manager, I know that I have these holdings, but I have too many holdings. We know that many mutual funds like quite diversified, and maybe I don't pay attention to what's going on always. And I think there is a paper today Chen was presenting in the morning, and it's called, it's his other paper called IQ from IP, where they show that mutual fund managers have limited attention. So I think actually in this paper, it's not necessarily the case, because Jennie shows that the effect's still there for the big stocks, for the big proportions of the stocks, but I feel that this point requires a bit more of discussion to convince me that, and the others, that indeed it's not just simply that as an equity manager, if I hear at some meeting that a bond fund manager changes something, I also start to pay attention to that. And also Jennie today gave some examples of fund managers who say that, no, we don't talk to each other. But I've also seen a discussion by Fidelity fund manager of this paper. And actually, I think the author of that discussion mentioned that, no, at Fidelity, we talk to each other. So it's not always the case that there are Chinese walls between two funds. So also the second thing, besides whether it's synthesizing or synergy, Jennie writes that we don't really need any private information or active sharing of information. It could be just that we have some booklets or research platforms, or again, just meetings. So there is no explicit mouth-to-mouth exchange, but they just have same signals. So I think I would like, it would be great. Maybe it's not easy, maybe it's very ambitious, but it would be nice to show whether it's, how I call it, non-active or semi-active communication or information spillover. And why do I use all these words? Because again, in the paper, this active exchange of information spillover used many times, and it's not always clear at which part is suddenly active or it's not active. So I think I would like to see more structure there. And because for the non-active one, as I said, you don't really need any exchange of information, but if it's exchange of information, it could come from service providers and banks, as in the previous literature, or it could be again from the board of directors, because you know that bond fund manager might know someone in the firm, the stock fund manager doesn't know, sorry, equity, and then the bond one could share this type of information. I looked for the couple of papers, and one is by Martin. I don't know if he's still at the session, but they'll use a broker's recommendation as public info proxy. So potentially, I think it might be the case that you could check whether these changes coming more often for these recommendations by when these recommendations are not there, or the other way around, whether you could see that you know what to change already before. So some, again, minor comments. It's how to distinguish potentially these two channels, whether it's passive or active sharing. Would the results be different for competing and cooperating mutual fund families? So what I mean here, I think if for the competing mutual fund families, the results would be still there, it means it would be kind of goes towards passive spillovers. Because why would I go to the bond fund manager and share some information if I try to be the star fund in this family? However, if it's cooperating one, I would expect this effect. I think, if I'm not wrong, that these papers still talk about equity funds. So probably it would be nicer to see whether it still holds for the funds which are bond funds and equity funds, whether there is competition, even if they trade in this segmented markets. So the second channel would be to see employment history. I think during the recent decades, more and more fund managers change their positions, go from one sector to another sector. I think it was also a Fidelity guy who mentioned that in his discussion. So probably that would also go towards the active channel, because it means that if I know someone, I'm going to share this information instead of just putting like a prospect of this fund information and go further. Another thing would be to look at the information intensity. There is a working paper that shows that some funds, some stocks have this more information intense, and they produce large surprises to investors. So it would be nice to see whether there is some cross-sectional predictions for these types of stocks. Also, I was a bit surprised. 13F holdings were never mentioned, so now it seems CRISP has all these holdings. And there is a nice section about initial acquisition. Jennie probably didn't have lots of time to talk about it today, but what they show that when bond gets acquired for the first time, then information benefits would be the highest for the equity fund manager, and then quarter by quarter, these co-holdings, their benefits would be reduced. But what happens for the first funds which get this, actually I also don't see the subtitles when it's like full screen, but I think I'm almost done.
No problem, yeah.
Yeah, okay, because I see you're raising something, but I don't see anything. Then also, if these mutual fund families do it, it would be nice to see that they do it on purpose and they know about this advantage. And so when they when they have equity funds, when they form new bond funds, would be there some bias towards bond funds, towards bonds, which already in the equity funds of their portfolio, so that there is some similarity bias or something else going on. And the last thing Jenny mentions in the paper, that not so many funds hold together both equities and bonds. So what she means by that, that it could be a mixture strategy, or also another way around could be that the same fund manager would trade equities in one fund and bonds in another. Very small sample, how it's written in the paper, but still, I would like to see whether the results for that sample is stronger than for the rest of the paper. Again, thanks a lot. I was very happy, very excited to read this paper. I think it's really, really nice idea, and you could do it only when you come like from another strand of the literature and that you bring something new. Thanks again, and thanks to everyone for staying with us until the end. Thanks.
Excellent. Thank you very much, Nataliya. That was a fantastic discussion. Would you like to take a couple of minutes to respond, Jenny, or shall I go to Q&A straight away?
Absolutely. Nataliya, thank you very much. It's quite overwhelming to reading this paper, giving us so many results. I like to comment on one thing. So the result, we have a simple idea and a clear, important finding. The thing is, we don't have a clear information channel. How this equity and bond communicate? We don't have this smoking gun, how it works, right? But do we really need such things? So with this question, when I'm presenting the paper in the Q Group conference, you can meet a lot of those Wall Street participants, including Fidelity's persons. So then people start to think about it, talking to me that it's actually really helpful just to have a listen to another opinions from another side. You know, you could be just under the same roof, although you and I don't know each other, we don't need to communicate. But by listening to the equity side or the credit side, in particular credit side, asking some questions, showing their concerns on this potential firm, that can inspire the equity. Because as I mentioned, creditors really have some unique information or different perspective on the firm, which the equity side doesn't pay attention. So based on a lot of the discussion with the Wall Street, it seems like first, many of them don't have been aware that the equity and the bond really communicate, okay? And if they communicate, it's very likely to be a passive way. They just listen, but not necessarily to, hey, I'm aiming to do it. But then you're asking for how this is gonna change. Hopefully after we presenting the paper, a lot of Wall Street people talking to us say, hey, this is really something we should do. That's the whole purpose of this paper, to tell people, you probably should get attention to both the equity side and the bond side to build up some augmented information. That's the purpose of it. But at the moment, the entire mutual fund industry is not doing that yet. That's why the cross-holding percentage is extremely low. We hope to see, you know, after 10 years, you can write another paper just showing after Pharma French posting their factor model, how they disappear after 10 years. This is relatively new and it's not reaching to agreement within the industry yet. So we hopefully to advocating, you know, you should not only looking at equity, looking at a bond helps, you know, you should look at it together. Appreciate it. I'm welcoming to any questions.
Okay,